I do not like overpaying for my stocks. The stock market year to date is up big, over 15% at this moment in time. And that has led a lot of investors to feel bullish on the stock market. I mean, it's pretty basic, right? The stock market goes up and people begin to feel all warm and fuzzy on the inside. I, however, do not think like this. And I miss the good old days back in 2022 when I could log into my brokerage account any day of the week and get a solid deal on my favorite stocks. And funny enough, that's when everybody, especially on Reddit, was super pessimistic about everything about the US economy. Don't get me wrong, it is a little bit disheartening to deposit money into a brokerage account and see the balance not go up. It kind of feels like you're throwing money into a fire pit, but that goes away with time because what's really throwing money into a fire pit is buying stocks at an elevated price and then being burned. I did that in 2021 due to my younger, inexperienced self, and it took me all of 2022 buying in at lower price points, decreasing my cost basis, and this recent bull market to just finally break even with my portfolio. And I feel like now I'm in the same situation. If I want to buy stocks, I have to pay 15% more than just a couple of months ago. I'm a big fan of the mean reversion model due to its simplicity and just gives you a good long-term idea of when we might be overvalued, when we might be undervalued. So for example, we can clearly see the dot-com bubble, the lows of the '08 recession, and the highs of the pandemic. And right now we're just heading in the wrong direction. We're still 1.2 standard deviations or 42% above the modern era historical trend value. So yeah, I think the stock market is a little bit expensive right now. Luckily, we can still find value. So this bull market is unique in the way that it's very narrow, meaning that the vast majority of the gains the indexes are realizing are due to a handful of large companies. So right now, when I'm looking for value places to put my money that haven't recently exploded in value and might be subject to a correction in the near future, these smaller names, really anything other than big tech, is what I am going to be focusing on for the time being. And it just so happens to be that the vast majority of broad market dividend growth ETFs are composed of these high quality companies minus large cap growth. Some of the most popular names in this category are VIG, VYM, SCHD, and these names are essentially flat for the year. They haven't exploded yet in value. I do want to make clear that there's no guarantee that these are going to explode in value. All I know is that in comparison to the QQQ, I don't need to pay a 30% premium to purchase these names, and they're still pretty high quality to me. So let's go ahead and filter this to see which dividend value funds are the most discounted right now. So we can filter by price change, and let's actually start with the ones that have been performing the best. And no surprise, we have TDIV, which is something that I was pretty recently talking about on this channel. This is a technology dividend fund. So essentially the tech companies that pay dividend, that's TDIV. And it's up 23% this year. Taking a look at the holdings of TDIV, it is very concentrated, to put it lightly, but it could be a nice complement in your portfolio if you already hold funds like VYM, for example. I think a lot of these names are high quality, aside from maybe Intel. But again, due to this 23% race up in price in just the past 6 months, right now, personally, I'm not diving headfirst into these names. And you know what? Shout out to NUSI. This is the NASDAQ 100 Risk Managed Income ETF. They have a mixture of calls and put options on the NASDAQ 100. And this has been doing terribly over the past, I want to say 2 years. But luckily for you NUSI investors, this year it is up almost 20%. Nice recovery. Okay, let's go ahead and filter by the underperformers of the group so we can potentially find some good deals here. So the first two here are outliers. They use leverage, so I'm going to ignore them. And that leaves the number one spot, so to speak, with the Global X Super Dividend US ETF. Going straight to the source for this one, Div gives you access to 50 of the highest dividend paying equities in the US. Pretty simple strategy, maybe not the best strategy ever. And that gives you access to these companies right here. Not super recognizable, maybe aside from IBM. Because this only focuses on dividend yield, the energy sector is heavily overrepresented, and I think that's the Achilles heel of this fund. And I say that because energy companies are very profitable. They make boatloads of money and they are kind of flat year to date. But if you look to just last year, in 2022, they had massive run-ups in value. So that's why right now, I don't think they're necessarily a great value. One name that is standing out to me here is ticker SPYD, the S&P 500 High Dividend ETF, which is down 5% this year. I'm sure you guys know about this fund. It's very popular, assets under management of $6.5 billion. The dividend yield right now is 4.61%. Taking a look at the historical yield, it's a little bit above the norm, I would say, indicating that it could be a good value. The fund is pretty heavy in both real estate and financials, and if the economy does have a recession or just goes south slightly more than anticipated right now, that is going to get hammered pretty hard. And yeah, taking a look at the top 10 holdings, this is definitely not my cup of tea. Ticker SPHD is another popular name. It's down a similar 4.5%, and this is the high dividend, low volatility ETF. The methodology here is a little bit unique. So the index, where does this say it? It's designed to measure the performance of the 50 least volatile, high-yielding constituents of the S&P 500 index in the past year. We're still pretty heavy in real estate, although the financial allocation is less, and right now that might be a positive considering the tenuous situation of the financial industry. And the top 10 holdings are comprised of low growth, relatively low volatility names with a good average yield. In fact, the yield of the fund right now is 4.2%. And right behind SPHD, we find SCHD. This is a fund that I think is super high quality, and right now it happens to be down 3.34%. SCHD has a fantastic track record. In the past 5 years, excluding the dividend, it's up 44%. It held on to its value fantastically in 2022, and so far it is still at an attractive valuation. It hasn't raced up in price. I also really like the index. It follows the Dow Jones US Dividend 100 Index. And for being a dividend fund, it does have a good amount of technology and thus growth associated with it. In fact, right now the #1 holding is Broadcom, a tech company, followed by Pepsi, Cisco, Home Depot, Merck & Co., a really nice diverse grouping of companies that I think are all very high quality businesses. And right now SCHD is yielding 3.65%, which is well above its historical norm, which helps me to confirm that this is indeed a good buying opportunity for SCHD. My opinion, not financial advice. But even aside from the starting yield, the growth associated with SCHD is very strong. So the longer SCHD remains flat, the higher the starting yield is going to go, and eventually the price will go up to match it, and the deal isn't going to be as phenomenal. So yeah, I'll leave this resource linked down below if you guys want to click through and see what's on sale right now. Keep in mind, all because something is cheap doesn't mean that it's high quality, and it could always go lower. But considering the overall market is a little bit hot right now, in my opinion, it's also narrow, led by a few leading large tech companies. I think looking for value right now isn't a bad idea, at least until this bull market widens out a little bit more. That's gonna do it for this one, and I'll see you guys in the next one.